weeks or 3 months ago.
And Carl and David, that was in response to a question about the equity market, which is fully recovered from the so-called Liberation Day losses. Howard Marks seems pretty skeptical that everything is as good as it was, given the dual risks that we face on higher inflation and weaker growth, which nobody knows which one's going to be a bigger one to materialize and how.
Yeah, we're starting to look for, some of the hard data to reflect tariff uncertainty. I mean, used cars today, Sarah, is a bit of a story. Manheim comes in for April up 4.9. That's going to be the biggest jump since August of 22. And you might expect some people to start asking for a little bit more for a used car, knowing that what's going to happen to the list price of a new one.
Right, rates are still high too. You know, on Fed Day, we always do this great chart, thanks to our data team, Nick Wells and the data team at CNBC, of where rates were when the Fed right before the Fed started raising rates. That was March 2022, and where we are right now, just to show you how it impacts Americans. Right, so the 30-year mortgage rate, when the Fed was about to start raising rates, 4.29, and that's elevated because going into the Fed rate hike, it had started creeping up. We're now, just below 7%. Credit card rates still in the 20%. Used vehicles, because you mentioned it, still high loans to borrow. And this is something the Fed knows. When they say we're still restrictive, David, this is what they're talking about, meaning they still have high rates, which ultimately, put a damper on spending and on the consumer. The problem is why it's not such an obvious bet that they should be cutting right now is inflation. And inflation expectations have started to rise in surveys. Pantheon Macro put out a great chart showing inflation expectations up in surveys like the University of Michigan. When they ask consumers, what do you expect for inflation? Expectation is higher. Look at that spike we've seen in 5 to 10-year inflation views. The thing is, the market views, what the Fed also pays very close attention to, 5-year forward as an example, hasn't really flashed any signs of inflation. So it presents a bit of a predicament, and that's why I'm curious how the Fed chair is going to talk about the inflation risk and what they're bracing for, because it really is too early to see the impact of the tariffs.
Yeah, well, there may be an impact from lower fuel prices or lower oil prices, Sarah, as we continue to bounce around below $60.
And that ultimately could have a big impact on the consumer as well. I was talking to Steve Leisman about it yesterday. Consumer prices, usually oil and consumer prices are correlated. The thing is, this time around, and that will keep inflation rates down and maybe make it easier for the Fed to start to cut earlier rather than later. The problem is, are we going to start to see it in building materials, in some of the places that have put tariffs on, that do filter into those consumer prices in the overall economy, apparel prices, for instance, and accessories prices, where a lot of the goods do come from China? I think that's the question. If you're looking for why the Fed should be cutting, I mean, the Treasury Secretary, Scott Bessent, has said, look at the 2-year yield. So if you look at the 2-year yield, which is the closest bond yield that tracks the Fed policy rate, the blue is the Fed policy rate, the orange is the 2-year. Obviously, they track each other pretty closely. Market telling you that the Fed is too tight and it should come down. As you can see, it's below that blue line. So again, the Fed's going to have to balance a mixture of market signals and economic data that doesn't necessarily point them in one direction or the other at this point.
Yeah, we were mentioning Wynn earlier this morning, last night delaying a remodel of the Encore Hotel in Vegas because of furniture and fixtures coming from countries that have been hit by tariffs. And when they get more clarity, they might resume that project. Meantime, as trade and tariff deals do drive volatility in the market, want to get some more on rates, the Fed, how it's all playing out. Our next guest is in charge of corporate credit at Goldman, advising America's biggest companies on their multi-billion-dollar financings. Johnny Fines here at Post 9, Goldman Sachs Global Head of Investment Grade Credit. It's great to have you back, Johnny. Welcome.
Good morning, Carl. Thanks for having me.
I love your line that corporate bond liquidity has never been better in your career.
Correct.
In your view.
Correct.
What accounts for that?
So I think there's been a lot of evolution within the corporate bond market over the last 10 years, and probably more accelerated so over the last 5 years with electronification. The growth of ETFs that have become a major source of risk transfer in the credit markets, as well as portfolio trading, which you can think of as a bespoke, customized ETF. that now together represents around about the third of all the trading volumes that we do between IG and high yield at Goldman Sachs.
And all that volatility in April kind of didn't really impact volumes, right?
Actually, it created an increase in volumes. Like when I kind of think about what are the markers of liquidity, it's the volumes that trade, it's the response under stress, and it's bid-ask spread. When we kind of think about that second factor, response under stress, I mentioned ETFs. They represent, for the most part, around $10 billion on an average daily traded volume basis. During April, that went up to $30 billion. And we've seen this time and time again over the last several years, that this response is a greater array of trading activity in times of stress in credit markets, very much in the same way that it has been in equity markets as well.
Didn't think we'd start off on liquidity, but since we're there, Johnny, I wanted to get your take because I, spoke to Mark Rowan on Monday and Jonathan Gray, both, of course, who have very major efforts underway at their respective alternative asset managers in the private credit markets. Rowan, in particular, who's been a spokesman for those markets for some time, talking about, hey, in 18 months, you're not going to know the difference between private investment-grade credit and public. Take a listen to what he said, because I would love to get your response.
Okay.
We have 10% of the trading capital in the world for fixed income that we had in 2008, and markets are 3 times their size. We have a historical, nostalgic view that there's liquidity in fixed income markets. There's not. There's only dealer liquidity. Why should what's happening in a private investment grade be any different than a public investment grade?
All right, Johnny, your chance to respond to Rowan.
So I never like disagreeing with Mark, first of all, because it hasn't really paid very well to do so, given how successful he's been. I think when I think about private credit, and I think about it as an alternative source of capital for the clients that we cover and engage with every day, I see this as an incredibly welcome alternative to the public credit markets. The public credit markets are standardized markets. They have standardized disclosure. They have credit ratings from S&P, Moody's, Fitch, the 3 biggest rating agencies in the world. They have standardized reporting, and the securities that are issued in the public market are standardized in many ways as well. That means that the investors that traffic in those securities generally will pay a premium for that standardization. The wonderful thing about private credit as it has emerged is, first of all, it's emerged at scale, and secondly, it's emerged as a bespoke, customizable source of credit for issuers who want to access that channel. And so, of course, it will grow in liquidity because the size of the market is growing as fast as it has been. But the relevance of it as a solution for the clients that we cover, we've rebranded our business the corporate solutions, the capital solutions group, as opposed to solely just the financing group, because we want to be able to advise our clients on all of the alternative ways that they can think about raising capital, whether it be public intermediated, whether it be private capital from our own asset and wealth management group, whether it be intermediated private capital, which is looking more
But
and more.
what about this argument that really you guys, you just started off talking about liquidity and there being a lot of it? Rowan says that's nonsense. It's not true. We're nowhere near where we once were prior to the financial crisis.
So the amount, where is correct is 100%, is that the dealer capital and dealer inventories that once sat on balance sheets at the banks, that doesn't exist anymore. That doesn't exist anymore to the same degree because of the way that financial regulations changed post the global financial crisis. What's happened instead is that capital markets sat there and they bemoaned the lack of kind of change in regulatory reform to enable balance sheets to be committed to this business more successfully again. So instead, they created these evolutions. And the evolutions that were technology-based, again, ETFs, portfolio trading, that has been what's reliquified the corporate bond market. And as I said, made it more liquid than in any other time that I've seen during my career.
I think Sarah has a question.
Yeah.
Well, okay, now that we've established the liquidity, I'm curious what you think about Fed Day, Johnny, and whether the market's now expecting not fully priced in till July. Where do you think the scope for disappointment is today in the news conference?
So I think that the Fed chair will continue to be non-committal. I don't envy his job right now because there are so many cross currents that are taking place within government policy. It's hard to really ascertain which ones are going to be inflationary, which ones are going to be contractionary, and which ones are going to impact unemployment. What's pretty clear is that economic growth is going to deteriorate potentially meaningfully into the end of the year. But remember, the Fed does not have a GDP mandate. It has an inflation and an unemployment mandate. And while soft data looks weak for both of those in terms of higher inflation expectations, even though the market doesn't say that, soft data says unemployment is likely to tick up. I think they're really going to wait for that to be affirmed in the hard data, and we may not see that for the next month or two. And I expect the Fed chair to say we're going to be in a wait and see mode until we really see this impact the hard data.
Johnny, I want to finish up on our conversation here in terms of liquidity. There's a proliferation potentially of ETFs that are going to feature a good amount of private credit and potentially offer daily liquidity. Apollo has tried. Others are going to follow. Do you think those products can be successful?
I think they can. I think at the end of the day, one of the allures and attractions of private credit, we said because it's not standardized, it's going to be invested in by capital that is looking for a higher return than standardized super liquid markets. And therefore, that's going to be attractive for investors to kind of think about whether it be like direct investment or ETF investment. If they can get incremental yield via these ETFs, I think they will find that as an attractive source of capital for them to look to deploy their funds. So I would expect them to be successful, yes.
And to be able to maintain daily liquidity without, I mean, what happens if there's a big event and everybody's got to sell?
Of course, but it's the same with any ETF, whether that be in stocks, whether that be in public corporate credit, or whether it be in private. I would always expect that these private credit ETFs would have a mix of both public, easy to trade, liquid corporate credit, as well as private, more difficult to trade credit. But the underlying market makers will be able to provide daily liquidity in those ETFs.
We had Jan on Friday, Costin yesterday, Kaplan this morning, and you. So we're grateful to Goldman for helping us understand the environment we're in. Johnny, thanks. Good to see you.
Okay, thanks for having me on. Great to see you.
All right, as we head to break, here's our roadmap for the rest of the hour. Home builders under pressure this year amid concerns about the broader economy.
So just remember.
Rates. Taylor Morrison, CEO, joins us with her pulse on the housing market.
Pharma's under some fire. Shares of the vaccine makers getting slammed this week following the appointment of that new FDA vaccine chief. We'll talk about what's ahead for that group.
And Disney shares having a good morning so far.
They lied.
There's financial results and also, of course, plans for a new theme park and resort in Abu Dhabi. We're going to be joined by the company's CFO, Hugh Johnson. First, we'll talk a lot more about the results. That's after this. All right, take a look at shares of Disney having a very strong day. Had been up as much as 10%, but this is right near the highs, of course, largely on the strength, as we've told you, of earnings that were far above what the analysts who follow the company had anticipated, whether it's direct-to-consumer profitability there soaring, or parks and cruises, overall experiences showing real underlying strength, free cash flow generation far above what had been anticipated. Even linear cable networks actually were up 2%. Yeah. Imagine that. That all contributing to a very strong morning, but also this announcement as well. Hard to say how much of that is a result of the increase in the stock price as well. That they're going to be building a new resort. The they here, though, really is a partner, Miral, in Abu Dhabi, which will take on all of the building and all of the capital allocation as well. But Disney will oversee it and will make decisions, of course, about all the attractions. And everything of that nature, resulting in a royalty payment stream. Did have a chance to talk to both Bob Iger, of course, the company's CEO, and Josh D'Amaro, who runs parks and experiences. I asked D'Amaro as well about whether the company is seeing any weakness in another one of its parks in Shanghai, given, of course, the increase in tensions between China and the U.S.
Something we track very, very closely. Volumes in Hong Kong and in Shanghai remain at record levels, quite frankly. There is no detection of anti-Disney sentiment in the area. Again, we've built amazing assets both in Hong Kong and Shanghai, and we've continued to invest on that front. So, although the Chinese consumer is a bit unstable right now from a volume and demand standpoint, our parks are very healthy.
Carl, perhaps, something of a surprise there that they've seen no weakness. Of course, strength across the board in parks, again, is contributing because you might have imagined, particularly, towards the end of March, that there might have been some weakness. And by the way, the guidance at this point seems to incorporate continued strength. And while our parent company, Comcast, is opening Epic not too long from now, they don't see it as necessarily taking away in terms of share.
We always think back to Hugh Johnston's comments last year about, I think the term he used was normalization regarding guest count at the parks. It'll be interesting to see if he comes up with another word to describe the environment we're in right now.
Yeah.
All right. We'll find out in a few minutes.
We are going to find out. There he is. Hugh Johnston will join us, of course, go over really the earnings, given we had a good long conversation with Mr. Iger and Mr. D'Amaro about the new park. Sarah?
Also, David, I think Abu Dhabi. I mean, interesting. We've been here at Milken. How many investors are talking about the Middle East right now? I think there was a greater presence here, and I think that there's a lot of interest in capturing what is a whole new segment of the population, of the younger population for Disney, right? Abu Dhabi, it's Africa, it's the Middle East, it's South Asia, all within a few hours. And I know there's a Ferrari World already there and other types of attractions.
Yes, they got a water world, a Ferrari world, a Warner Brothers world. I don't really know. They got a lot of worlds.
Big boost for UAE. President's heading there next week. I was thinking either Dubai, Abu Dhabi, Riyadh. I'm sure they're all competing for tourism as all of these economies try to diversify away from oil.
Yes, and it's interesting because they have been typically an allocator of capital. They still are largely, but they are also now looking for significant investment in the region itself, Sarah, which is somewhat different in the way that they've been viewed for years, of course, which is simply a lot of money coming out. Obviously, that is still the case. Mubadala, for example, I had joined me on a panel as well. 40+% of their assets are invested in the U.S., but a lot of that money is now going to help development in the region as well.
The other thing I might add is that I think the phrase they used was this will be the most tech-forward park, right? It'd be curious to see what you can do with the theme park starting now, as opposed to Disneyland or Epcot in the 70s or 80s.
Yeah. And Iger said they were doing AI-generated drawings on the airplane. I don't know. All right. Interested to see what they look like. Yeah. We'll go, Sarah. 7 years from now. We'll head over there.
Great. Yeah. Let's go for the F1 race. It's the last race of the year. and it's increasingly, I think, a destination for big business and investors. As we head to break, check out the biggest losers on the S&P 500 this morning. Overall market is higher, but do have some losers, some tied to earnings. Look at Dayforce down 9.5%, International Flavors down 6%. Plus, we're keeping our eye on healthcare, one of the worst performing sectors this quarter. Threat of tariffs, tough regulation, and now the appointment of a new FDA vaccine chief. We're going to talk about how to navigate all this volatility in the space and the key names that are being hit the hardest right after a quick break.
NBC Plus.
Number of drug stocks got hammered yesterday after the FDA named a key critic as its new chief of vaccines. Our Angelica Peebles is tracking that action and joins us with more on what's ahead for some of these pharma names. Hey, Angelica.
Hey, Carl. So, new SABR director Vinay Prasad is very vocal about his beliefs and his criticism of the FDA. He's called annual COVID boosters a failure of the FDA regulation. He's criticized the use of accelerated approvals, and he's accused his predecessor, Peter Marks, of rubber stamping drugs. For example, one of the things he wants to see is cancer drugs to show that they can actually keep people alive longer versus just stopping tumors from growing. And that's a difference that can add years and millions of dollars to clinical trials. So his appointment adds yet another layer of uncertainty for drug makers that have really been under pressure since RFK Jr. was named HHS secretary back in December. Then you have the White House trying to add most favored nations drug policy to the reconciliation bill. Now, that would tie the price of drugs in Medicaid to the lowest price that similar countries pay. And initially, it wasn't seen as a huge deal when this came up last week because Medicaid already gets the best deals around. But the industry realized that it would also affect the price of drugs in an even bigger program called 340B. And one lobbyist told me that it's like preparing for war right now. Pharma CEOs had an emergency call over the weekend, and they're taking their case to the Hill today while they're in town for a pre-planned pharma board meeting. And of course, don't forget about tariffs. The public comment period for the formal Section 232 investigation ends today, and President Trump said that he plans to announce those tariffs within the next 2 weeks. So there's just a lot going on right now, guys.
I'm glad you highlighted it. I was with some healthcare execs this week, and they were saying the most favored nation status issue is a potentially bigger one, a bigger problem than even pharmaceutical tariffs. So that's something to watch in the reconciliation. Angelica, thank you. Angelica Peebles. Time now for CNBC News Update. Let's get to Courtney Reagan. Hi, Courtney.
Hi, Sarah. Well, Pakistan's prime minister vowed retaliation today for Indian missile strikes that he also called, quote, an act of war. At least 26 people were killed. India said it struck 9 terrorist sites, some of which are linked to an attack by Islamist militants on Hindu tourists in Kashmir last month. Tensions are rising between the nuclear-armed neighbors and have been since the attack, which India has blamed Pakistan for backing. The conclave to elect a new pope is set to begin in just minutes. There are 133 voting-eligible cardinals who will be sequestered inside the Vatican to decide who will be Pope Francis's successor. The first vote will take place at 7 local time, or around 1 p.m. Eastern. The cardinals will send up white smoke if they have made their selection, or black smoke if they haven't reached a 2/3 majority decision. And President Trump will reportedly announce next week that the U.S. will refer to the Persian Gulf as the Arabian Gulf or the Gulf of Arabia. The Associated Press says 2 U.S. officials confirmed the move. Iran is already pushing back, saying the renaming would indicate hostile intent towards Iran. Sarah, back to you.
Two Gulf changes in a matter of months on the names. Thank you, Courtney.
Thanks.
As we head to break, biggest gainers right now on the S&P. Bunch of earnings stories in there. Look at Disney, up 10.3%. On the beat and the raise, plans for a new theme park. CFO Hugh Johnston joins us exclusively to discuss the latest results and the outlook for the media giant. We're back in just 2 on Squawk on the Street.
Have weapons.
Calm.
Fed's gearing up for its latest rate decision, followed by Fed Chair Powell's news conference this afternoon. Our senior economics reporter Steve Leisman's in D.C. with more on what investors can expect on, I think, the first meeting post-Liberation Day. Steve?
That's right, and the April 9th rollback. So, Carl, in the movie Dumb and Dumber, Jim Carrey famously utters the lines, So you're telling me there's a chance, and that's what the market needs to hear today from the Fed and Chair Jay Powell when it comes to the possibilities of rate cuts amid all this tariff turmoil. Here's what I see are the keys to the meeting today. The tariffs levels remain greater than expected, even with the April 9th rollback by the president. Soft data, it's cratered, but the hard data has held up, especially that jobs report we got on Friday. So leading to the main question, does the Fed lean towards the inflation or the recession risk? The last statement emphasized the uncertainty in the outlook, but the most important line read, quote, the committee is attentive to the risk to both sides of its dual mandate. That, of course, keeps the door open for rate cuts, doesn't promise them, at least till it's clear which side of the dual mandate needs urgent care from the Fed. As Jason Furman said in a recent New York Times interview, quote, the best thing for the Fed over the next few months is to be behind the curve, because the alternative is to risk being ahead of the wrong curve. Futures markets continue to look for 3 rate cuts this year, 1 in July, 1 in September, December. But markets have shown they can adjust to incoming data. That first cut, it had been firmly priced in for June. It's now just at 30%. And the odds on the first cut have shifted to July. So markets, they seem to have come to grips with the idea that the Fed is not moving preemptively despite the president's protestations. Now we wait for the data to affirm the expectation for rate cuts and for Powell and Fed to keep alive the idea that there's a chance for cuts as soon as July. David?
Steve, thank you. Steve Leisman. Let's turn back now to shares of Disney. They are certainly one of the highlights of the morning, up over 10%. This on the back of what were stronger earnings on both the top and the bottom line. Also, perhaps a somewhat surprising uptick in the number of streaming subscribers quarter to quarter. Disney CFO joins us exclusively. We'll talk about these numbers and, of course, the outlook. He is Hugh Johnson. Good to have you this morning, Hugh. I want to start off on the outlook itself, because you spoke in very positive terms on the conference call in terms of even 2026 and your confidence. And I just wonder, given your guidance and obviously the quarter you just reported, but the overarching economy, Steve Leisman just talking about it, and worry still about the consumer, what is underlying the confidence that you guys can meet these higher expectations?
Yeah, good morning, David, and great to be with you from Abu Dhabi, the home of the next great theme park for the Walt Disney Company. Couldn't be happier to be with you all to talk about our performance. In terms of the outlook, obviously, we tend to be more on the conservative side when we guide. We don't like to miss for all the obvious reasons. What gives us the confidence is what we see in our own data right now. In particular, with our parks, bookings are up for Q3 of 4%, and that's with about 80% in. And Q4 up about 7%, and that's with about 55 or 60% in. On top of that, we're seeing great results with the streaming service, all of the content that we're adding, and obviously we're quite optimistic about ESPN flagship coming onto the streaming service as well. So those two variables are really driving a lot of what we're seeing in our own data, which tells us we can make this guide and make it comfortable.
Yeah, I want to talk direct to consumer and ESPN, but let me just come back to parks and experiences. I mean, given the economic tumult, so to speak, are you surprised the consumer is as resilient as they seem to be right now?
Well, it's interesting. To me, there's something of a bifurcation that you see. The consumer sentiment data is quite negative, but as we look at the stratified data on consumer spending, upper and middle income level spending is actually holding up quite well broadly. So from that perspective, we do feel good that we've got outside validation. And then combine it with our inside validation in terms of bookings, we certainly feel positively about it. I think in many ways what it comes down to is the consumer is prioritizing more, and they like what the Walt Disney Company is offering, so they're willing to pay the price for the value that we're delivering.
Yeah. Speaking of value delivering, direct to consumer, as I mentioned and you referenced briefly, strong, up 1.4 million subscribers quarter to quarter were added, and obviously profitability up substantially. What does that look like in terms of scaling that business and the EBITDA performance that you can conceivably get given that scale with, I assume, costs sort of staying where they are, Hugh?
Yeah, they largely are. We'll continue to invest, obviously, in technology to make the product better and better, particularly around recommendation engines and making the product easier and more effective to drive engagement and to lower churn. But in other areas like G&A and marketing, we certainly have the opportunity to continue to control costs. I think at the end of the day, that product is delivering so much value to consumers that they are willing to pay. And in fact, over time, I think they'll be willing to pay more for it. So we're certainly very optimistic in not just the near term in terms of the subs, but for this to be a growth business for the Walt Disney Company for a long, long time to come.
Yeah, well, all right. You mentioned over time they'll be willing to pay more. You have already raised price. I mean, I can go back to that day, of course, where you guys announced that you weren't with the company, but I was with Bob at the $6.99, I remember. We're far above that. Are you indicating that your expectation that there's more price elasticity in there for you and you can charge more fairly soon for the service?
Yeah, I do think so. I don't know about fairly soon, but I think we'll probably be in a steady pattern of increasing prices on that product. And the reason is quite simple. If you think back to what people used to pay for the cable bundle, it was substantially more than this per month. And at the same time, I'd argue this gives you a lot more value because it allows you to control what you watch. It allows you to control when you watch it. It gives you content that you wouldn't have necessarily had access to at the moment that you wanted to have access to it. So I think both the value is really strong and the price is still a good bargain. Obviously, when these products were introduced, everyone was pricing them in a way to drive adoption as quickly as they could. But now that we're north of 180 million subscribers, we certainly feel good about the fact that we have lots more subscribers to add, but can do so by adding content rather than by necessarily holding prices down.
Yeah. All right, linear networks. You know, we're going to have a new company. It's going to be called Versant, by the way. I don't know if you heard that news, Hugh. And it's going to be made up of a lot of linear cable networks. Thank you so much. Yeah, well, I was encouraged by the fact that your operating income was up 2% in linear cable networks, despite the fact that revenues were down 13%. Is that the new normal? I mean, have you guys cut costs enough that you can continue to produce operating income increases at linear cable?
I'm not sure we go quite to that level. There was a little bit of timing year over year in terms of when shows were introduced because of the strike back in 23. So I wouldn't think of the positive on linear from an operating income standpoint to be the new normal. But we are working hard to make sure that we rationalize costs, that everything we spend is really dedicated to getting in front of the viewer as opposed to cost behind the scenes. We're combining things where we can as well. But I don't know that I'd call growth in that business operating income a new normal.
Yeah, you're bumming me out here as we get ready for our public debut. Sarah's got a question. Sarah.
Hi, Hugh. It's Sarah. I'm in LA. You're in Abu Dhabi. I wanted to ask you about tariffs. 100% tariffs on films made outside the U.S. That's what the president posted about this week. The White House walked it back a little, said they haven't made a decision. They're exploring that option. What would that do to your business and to the industry? And would it indeed make Hollywood great again?
Well, I think it's a little bit early to try to do the math on 100% tariffs or anything like that. What I was actually most encouraged by was the president talked about the fact that he wants to help the industry and he wants to make the industry stronger. So we certainly are more than happy to help in terms of designing things that would make sense to make the industry stronger. And we look forward to doing that.
Okay. Finally, let me end on ESPN Plus. The debut is not far away now. What are your expectations at this point for the service? And I am also curious about the continued relationship you have with Penn Gaming, which I believe is providing certain part on the platform in terms of the ability to bet and is under siege from its own activist shareholders. Does that partnership continue? And again, back to sort of your expectations as to how the debut is going to look.
Yeah, we're excited, obviously, about ESPN Flagship, and once we name it, we'll sort of start calling it that. But we're certainly excited about the product and all that it has to bring to the table. Obviously, it'll have all of what ESPN Linear is in terms of all the content and all the great shows that we have. But then in addition to that, as you noted, we'll have the ability to do fantasy, we'll have the ability to do gaming, we'll have the ability, fantasy games, we'll have the ability to do betting. Couldn't be more excited about the design of that product. It also, in a lot of ways, really makes ESPN go from being a sort of hybrid digital and linear product to really offering, I think, the first fully digital product for ESPN. Much more interactive than people have seen in the past. So we couldn't be more excited about it. As Bob noted earlier, we're going to talk about names and pricing next week on it. But we also think it's going to be tremendously additive to the Disney Plus service as well. And we think it'll be an exciting way for people to access sports through Disney Plus.
Yeah, all right. We'll stay tuned for price and name. You can't use Versant, sorry. And the Penn Gaming relationship remains in place as well?
It remains in place right now, yep.
Okay. Thank you. Hugh Johnson, CFO of Disney. Appreciate your time.
Okay. Thank you, David.
Well, guys, the Trump administration starting to put millions of defaulted student loan borrowers into collection this week. This is a big deal. Some 5 million of them, according to the Education Department, are actually in default. So I did sit down last night with the Secretary of Education, Linda McMahon, who's here in LA for the Milken Conference, and asked her about this. Here's a sneak peek of our interview.
You don't forgive loans, you just transfer them to someone else. Someone's going to have to pay the tab. If you get a mortgage on a house and you don't pay, they take your house. If you get a loan on your car, you don't pay, they take your car. But with a college loan, there isn't any collateral really to take, so taxpayers really become on the hook, and it's just not fair. So what we've done, if you think about this, since March of 2020, there's been no collection process for student loans. That has been an increase of $60 billion in these outstanding loans. The total loan debt is almost $1.7 trillion for student loans. So we've announced today, yesterday, May 5th, that the clock starts. We don't want people in default. First of all, it's not fair, but second, it's bad for the person in default. You can't buy a house, you can't buy a car because your credit score is just gone. So we're trying to help you get back on a payment plan that in not too long a time could help raise your credit score, and it's the best policy for the country.
Secretary Linda McMahon explaining why the Trump administration is doing this. It's a complete reversal from the Biden administration, who basically let people not pay off those defaulted loans for 5 years, stemming from COVID during tough economic times, but it lasted for several years. Why she said someone has to pay the bill. It adds to the deficit, and now they're going to start collections. We're going to hear a lot more from Secretary McMahon, including her thoughts on Harvard, of course. That fight escalating this week with a new letter from her. That's next hour on Money Movers. But Carl, this is a big deal and could impact consumer spending. These are young consumers mostly that are now going to be facing payments. Otherwise, they're going to lose Social Security benefits and other government benefits. So we'll be watching for it in the consumer data. We're talking about, more than 5 million Americans actually in default and 43 million who have student debt. I would watch this when it comes to consumer spending.
Yeah. Meantime, Buttigieg is on the tape, still giving McMahon a hard time for calling AI education A1 education. Look forward to that, Sarah. Meantime, existing home sales in March, biggest decline in 3 years. Is there more pain ahead? How the crucial spring selling season's going with the CEO of Taylor Morrison in a moment. Got some more demand in the housing market today. Weekly mortgage apps suddenly surging 11% week on week. Conventional loans drove the gains despite some ongoing economic uncertainty. S&P real estate outperforming the broader market since the president took office. That said, some home builders well off of their 52-week highs. Names like NVR, Pulte down double digits from their peaks back in October. We'll talk about it with the CEO of Taylor Morrison in a moment, Sarah. I think this was the best jump for applications since early January.
Yes, housing market trying to figure out where prices go from here and where activities are. Also, there are higher tariffs, which raise construction costs, and the Federal Reserve potentially holding rates steady here. We'll talk about it all with Taylor Morrison, which is actually finding pockets of growth, but does expect tariffs to hit Q4 housing starts. Joining me here is Taylor Morrison CEO, Cheryl Palmer. Cheryl, it's great to have you. You talked about sort of the cadence of the quarter. Started off weak in January, stabilized, I think you said, in February and March. I'm curious what you're seeing in April and how that compares with activity in recent years.
Yeah, you're exactly right, Sarah. Thanks for having me today. We started off a little slow in January, and I think we're up about 10% in February, and then saw another 13% jump into March. April has been a little bumpy. As I said on the earnings call, Liberation Day was kind of a day that was unsettling for the consumer. There's certainly demand out there. We're seeing a lot of traffic. We're certainly seeing sales, but we're not seeing the surge that we would normally see between March and April. April would generally be a peak in the spring selling season.
Is it consumer sentiment or is it the inventories, a housing market dynamic? What is it?
I think mostly, you'll never be able to point to just one thing, Sarah, but I think mostly it's consumer sentiment, confidence. There's a lot going on out there, and they're trying to process what does it really mean for them. I think to fully appreciate it, you almost need to dissect the different consumer groups. When we think about first-time buyers, very rate sensitive, and the volatility that we're seeing in rates has an outsized impact for this group, and truly, leaning into what they can really afford. When you think about your move up, your second move up, and our resort lifestyle, maybe some call active adult, they're really focused on the macro. They've got the resources. It's not quite as much about interest rates as just how do they feel. They're making a very big purchase decision and just want to have a better understanding. So they're just taking a little longer. We're able to move them with incentives, but just taking a little longer than you would normally see in a very robust environment.
How do the tariffs impact your costs of construction and ultimately your financials?
It's such an interesting question, Sarah, because I've seen lots of predictions out there on what it means, and I don't know how we can know exactly what it means yet because we don't know what this 90-day pause brings. When we think about what we know today, and that would be more the universal 10%, it's immaterial. It's literally a couple hundred to a few $100s a house, and that's on newer starts that really will affect the fourth quarter, so it's a rounding error. If we think about 26, if all these tariffs were to go into play, it would have a more meaningful impact. The numbers that we've initially looked at is maybe 1 to 1.5% of purchase price. But once again, we don't know if all of that's going to come into play yet.
So does that mean it will not raise prices for the consumer on homes? And what's happening overall with prices? Because, that's been part of the pain here is that housing prices have not come down that much.
They haven't come down, but they haven't moved up materially either. And, it's always a little tricky when we talk about where are we raising prices or are we increasing incentives. So I like to look at net pricing. And once again, it's very, very not even market, sub-market, community specific. I think in the last quarter, we saw net prices move up in about 30% of our communities. But I would tell you those moves are much more modest, and I think that's okay. So if tariffs were to happen today, would we be able to take all of that? Probably not. It would probably be a shared expense between the consumer and the builder.
Cheryl, when it comes to sort of the buyer right now,
Yep.
What do you think is more important? Lower rates? What's going to get them to sort of the levels you might have anticipated previously? Lower rates or a resolution sort of on the tariff side? Is one more important than the other?
Once again, without being redundant, I think it depends on who. I think confidence is probably the more paralyzing effect today. I really do. I think some sort of stability and certainty on what all this macro noise means. I don't even know that it 100% has to be settled. I think it's more around just some confidence that we're moving in the right direction. The level of volatility moderates. I think when you think about the first-time buyer, rates are critically important. You know, what we are seeing is a true preference for new. I think the consumer, David, really does appreciate that there's some significant advantages if it's just that the inventory is, 40 plus years old, where that inventory sits, or our ability to help customers with some of these rate buy downs, forward commitments that really help them get into a monthly payment they can afford.
Well, we thank you. Who should Sarah, do you want to thank?
Thank you, Cheryl.
Thank you. Good to see you all. Thanks for having me.
Thanks for being here.
Bye-bye.
As we've been talking, markets coming off of the session highs here, the Treasury Secretary is testifying this time before House Financial Services. We're monitoring that hearing, but a few moments ago he did give some comments saying that China negotiations will take place in Switzerland on Saturday. He says they are not advanced discussions, but rather a beginning for talks. He said that some trade negotiations are, quote, quite advanced towards agreements in principle, but he would not say which countries might reach a deal with the U.S. this week, saying it would be detrimental to U.S. interests. Maybe David Market was looking for a little more granularity, given some of the promises or reassurances we got from the president in the Oval yesterday.
Yeah, I mean, some of the comments as well, I think, in terms of China graduating from developing country status. Nothing, right? You're looking for anything positive. Obviously, the idea that there are going to be talks that are getting underway perhaps as soon as this weekend in Switzerland is a positive, but as you see the Treasury Secretary there. But, of course, everybody trying to understand as well what exactly that means in terms of de-escalation, where we will end up in terms of what the tariffs may end up being. And we are seeing, a little bit of strength in the market, Carl, but not as much perhaps as might have been anticipated initially with those headlines from late yesterday. Right.
Well, while there isn't any sort of specifics on what de-escalation is versus what a trade deal would look like, there's a growing expectation among investors we talked to that those high, and he's called it unsustainable, the Treasury Secretary, rates will come down. We don't know where they'll settle, but that those will come down to give some breathing room, especially ahead of the holiday season and inventories. Don't miss Ken Griffin, Citadel, post-Fed meeting. That's going to be at 4:45 Eastern Time. And, of course, we'll be back here on Money Movers with a lot of pre-Fed discussion in just a moment. Stay with us.
RoseRoadBeauty.com.